Imagine a man who promised people a fortune in 90 days, and they believed him so blindly that the entire country rushed to hand him their savings. Now imagine that everything he sold them, every promise, every calculation, every guarantee, was nothing more than a beautifully packaged lie. This is not crypto. This is not Wall Street. This was 1919, and the architect was Charles Ponzi. At the time, America was desperate for opportunity. The First World War had ended, inflation was rising, and millions were searching for a miracle. Ponzi arrived exactly when the world wanted to be fooled. He claimed he had discovered a loophole involving international reply coupons, small postal vouchers used for foreign mail. According to Ponzi, these coupons could be bought cheaply in Europe and exchanged for far more valuable U.S. stamps, generating enormous profit through simple arbitrage. To ordinary citizens, the explanation sounded complicated, but also strangely brilliant. If they didn't fully understand it, that only made it more believable. Ponzi projected confidence, dressed in expensive suits, drove luxury cars, and carried himself like a man who had cracked the code of global finance. The public saw success and assumed it was built on genius. The truth, Ponzi never created any real profit. Instead, he used new investors' money to pay earlier investors, creating the illusion of astronomical returns. When people received their payouts, word spread like wildfire. Crowds lined up outside Ponzi's office. Banks begged to invest. Newspapers called him a financial wizard. Even regulators hesitated to intervene, fearing they might destroy a legitimate breakthrough. What made Ponzi dangerous wasn't just his scheme, it was his timing. He emerged in a world without modern financial oversight, without investor protections, and without digital transparency. People wanted to believe in shortcuts after years of hardship. Ponzi gave them a shortcut wrapped in charisma. Within months, he collected the equivalent of hundreds of millions of dollars in today's money. At the peak of his power, Ponzi made millions per day and became a national celebrity. Meanwhile, behind the scenes, the system was collapsing. There were not enough coupons, not enough returns, and not enough time to maintain the illusion. The scheme depended entirely on faith, and once that faith cracked, everything collapsed instantly. By the time investigators exposed the truth, Ponzi's empire had eaten the life savings of tens of thousands. His collapse destroyed banks, ruined families, and triggered one of the first major financial scandals of American history. But the most remarkable part is what Ponzi left behind. Not just a disaster, but a blueprint. His structure became the foundation for countless frauds over the next century, from Bernie Madoff to modern crypto scams. The world changed, technology evolved, markets grew, but the psychological hooks Ponzi exploited remain universal. Greed, hope, trust, and the belief that someone, somewhere, has found a secret path to effortless wealth. The irony is brutal. Charles Ponzi died broke, but his invention, the Ponzi scheme, became immortal. What if the most trusted man in American finance, the man who advised the SEC, chaired NASDAQ, and managed billions for the world's wealthiest families, turned out to be the greatest fraudster of the modern era? What if the safest investment in America was actually the biggest lie ever sold? This is the story of Bernie Madoff, the man who didn't just break the system. He exposed how fragile, blind, and corrupt the system truly was. For decades, Madoff was considered a financial legend. He built a reputation as a pioneer of electronic trading, a model of integrity, and a man whose investment fund delivered consistent returns year after year. While the rest of Wall Street swung between booms and crashes, Madoff's fund appeared immune to volatility. His returns were smooth, stable, and eerily perfect, so perfect that they should have raised alarm bells instantly. But perfection is seductive. Investors didn't question him, they worshipped him. Celebrities, hedge funds, universities, charities, European banks, and even world-famous economists poured billions into his operation. Many begged him to take their money. Madoff rejected clients just to appear exclusive, creating an aura of mystery that only amplified demand. If he was turning people away, he must be the real deal, or so they thought. Behind the elegant offices and the polished public image, Madoff was running a pure Ponzi scheme, even larger and more sophisticated than Ponzi's original. There were no trades, no profits, no strategies, no investments, just money flowing in and out of a secret backroom on the 17th floor, a room filled with old printers, forged documents, and employees who had no idea they were producing fake statements worth billions of dollars. The genius of Madoff's fraud wasn't in its complexity, it was in its simplicity. He exploited a fundamental truth about human nature. People trust consistency more than brilliance. As long as his returns looked stable, as long as the checks cleared, and as long as the story sounded believable, the illusion held. For over 30 years, Madoff deceived regulators, auditors, investors, journalists, and financial experts. The SEC received detailed warnings multiple times and did nothing. Large banks noticed irregularities and stayed silent because they profited from him. Funds knew the numbers didn't make sense, but they didn't want to lose access to his returns. Madoff didn't just fool people. He exploited their greed, their fear of missing out, and their blind faith in authority. The collapse came in 2008 during the global financial crisis. Investors panicked and demanded withdrawals. In a single week, redemption requests exceeded $7 billion. Madoff had only a fraction of that. The illusion evaporated instantly. He confessed to his sons, who reported him to the FBI. The aftermath was catastrophic. Over $65 billion in paper wealth disappeared. Charities collapsed. Retirements evaporated. Families lost everything. Several victims committed suicide, and even Madoff's own son took his life years later. Perhaps the most disturbing truth is that Madoff could have been caught many times. The system failed because the people responsible for oversight trusted reputation more than evidence, comfort more than confrontation, and illusion more than reality. Bernie Madoff was not simply a criminal. He was a mirror, reflecting back the greed, blindness, and complacency of an entire financial world. His empire fell. His name became synonymous with deception. But the vulnerabilities he exposed? They are still here. Imagine a technology so revolutionary it promises to change medicine forever. Blood tests using just a single drop, diagnosing hundreds of diseases instantly. Now imagine that every investor, every journalist, every world leader who praised it was praising something that never actually worked. This is not science fiction. This is the rise and collapse of Theranos, one of the most seductive and dangerous frauds in Silicon Valley history. Elizabeth Holmes didn't sell a product. She sold a dream, a vision of a future where medical testing became painless, cheap, fast, and accessible to all. She dressed like Steve Jobs, spoke with prophetic certainty, and built a personal myth around brilliance, discipline, and destiny. People didn't just believe her. They believed in her. And that was the key to the entire deception. Theranos raised hundreds of millions from the most powerful people in the world. Former secretaries of state, generals, CEOs, billionaires, politicians, global foundations. Holmes crafted an aura of inevitability, as if questioning her vision meant you were standing in the way of progress itself. But behind the scenes, the technology did not work. It didn't almost work. It didn't need more time. It failed completely, repeatedly, and dangerously. The Edison machine, the device that was supposed to run all these miraculous tests, was a chaotic mix of malfunctioning hardware, leaking tubes, overheating components, and software that gave wildly inconsistent results. The company ran internal tests that contradicted public claims. Engineers warned leadership. Scientists raised concerns. Lab directors begged Holmes to slow down, to fix the technology, to stop the rollout. Holmes refused. Doubt was unacceptable. Instead of fixing the product, Theranos fixed the narrative. They used commercial analyzers manufactured by other companies, but hid that fact from investors. They manipulated test data, cherry-picked results, and staged demonstrations. They pressured employees into silence with NDAs, threats, and an internal culture built on fear and secrecy. Holmes created a fortress around the truth, protected by lawyers, former military leaders, and a board too mesmerized by her charisma to ask basic scientific questions. Silicon Valley celebrates disruption, and Theranos weaponized that mentality, blurring the line between optimism and delusion. The collapse began when whistleblowers stepped forward, risking careers and safety. A Wall Street Journal investigation revealed the truth. Theranos technology didn't work, the company endangered patients, and the science Holmes claimed to have mastered never existed. The empire crumbled almost overnight. Patients received incorrect test results, false cancer warnings, inaccurate hormone tests, wrong readings for life-threatening conditions. Real lives were affected, real people were harmed. The fraud wasn't only financial. It was medical. Holmes was eventually charged with fraud, and Theranos dissolved. Investors lost nearly $1 billion. Employees lost jobs. The myth shattered. But the deeper lesson remained. Theranos succeeded not because the technology was promising, it wasn't. It succeeded because the story was irresistible. People wanted to believe in the next Steve Jobs. They wanted to believe in a young genius disrupting a stagnant industry. They wanted to believe in progress. Holmes understood this desire and used it. Theranos became a symbol of a dangerous truth. In an age of hype and hero worship, charisma can overpower evidence, and a compelling narrative can bury reality. The fraud collapsed, but the conditions that allowed it to flourish? They are still alive in today's tech world, waiting for the next visionary who can sell a dream too beautiful to question. Allen Stanford built one of the largest financial frauds in modern history by constructing an empire that looked luxurious, trustworthy, and impeccably legitimate on the surface. For years, he presented himself as a visionary banker, a philanthropist, and a self-made billionaire with a global presence. His company, the Stanford Financial Group, operated out of the Caribbean and promised clients a safe alternative to traditional banking. The centerpiece of his empire was the Stanford International Bank in Antigua, a polished, glamorous institution that attracted wealthy investors from around the world. The core of Stanford's fraud revolved around certificates of deposit, CDs, that offered unusually high and remarkably consistent returns. These CDs were marketed as safe investments backed by a diversified portfolio of international assets. Wealth managers, celebrity endorsements, and a carefully crafted brand image convinced thousands of investors that Stanford's products were not only legitimate, but superior to mainstream financial institutions. While typical banks emphasized stability and modest gains, Stanford promised reliability with a premium, a seductive offer for anyone seeking both security and profitability. Behind the scenes, however, the CDs were not backed by real investments. The supposed portfolio of diversified international assets existed only on paper. Stanford and his inner circle fabricated performance reports, forged documents, and manipulated accounting entries to create the illusion of steady growth. In reality, the money deposited by clients was used to fund Stanford's lavish lifestyle, pay earlier investors, purchase private jets, and sponsor extravagant sporting events. The bank was not an investment institution. It was a classic Ponzi scheme operating on a global scale. Stanford's ability to maintain the illusion relied heavily on offshore secrecy and political influence. By basing his primary banking operations in Antigua, he positioned himself in a jurisdiction with limited regulatory scrutiny and strong incentives to protect wealthy foreign investors. He cultivated close relationships with local politicians, donated large sums to political campaigns, and ingratiated himself with government officials who granted him favorable treatment. Regulators in the United States raised concerns multiple times, but internal conflicts and bureaucratic hesitation allowed Stanford to continue operating for years without meaningful intervention. His empire projected stability through spectacle. Stanford sponsored cricket tournaments, philanthropic events, and luxury gatherings designed to attract high-net-worth individuals. He surrounded himself with symbols of success: yachts, mansions, tailored suits, and media visibility. The appearance of wealth became his most powerful asset, giving investors the confidence to pour billions into his fraudulent bank. Many believe that a man living at such a grand scale must have built something extraordinary. The eventual collapse came when investigations by the U.S. Securities and Exchange Commission revealed massive discrepancies in Stanford's financial statements. Audits showed that the majority of the bank's assets did not exist, returns were fabricated, and Stanford had been running a multi-billion-dollar scheme for more than a decade. The bank was insolvent, investor funds were depleted, and the portfolio was largely imaginary. When the scheme collapsed, more than 30,000 investors across over 100 countries lost nearly $7 billion. Retirement accounts evaporated, savings disappeared, and entire communities suffered financial devastation. The aftermath was chaotic and drawn out. as victims struggled to recover even a fraction of their deposits through legal channels. Stanford himself was sentenced to 110 years in prison, marking one of the longest sentences ever given for financial fraud. Yet the broader consequences of his actions extended far beyond his conviction. The scandal exposed vulnerabilities in international banking regulations, highlighted the dangers of offshore financial havens, and demonstrated how easily charisma and wealth can overshadow due diligence. The Allen Stanford case stands as one of the clearest reminders that financial fraud does not always come from the shadows. Sometimes it comes dressed in luxury, smiling confidently, surrounded by the illusion of prosperity, an empire built not on assets, but on belief. Jordan Belfort's rise and fall became world-famous thanks to Hollywood, but the real story behind the Wolf of Wall Street is far darker, more calculated, and more revealing about the weaknesses of the financial system. Before the movies, before the legend, Belfort was a small-time stockbroker who discovered a simple truth. The easiest people to manipulate were not institutions or billionaires, but everyday, inexperienced investors chasing a dream of quick wealth. He built an empire around that insight. Belfort's company, Stratton Oakmont, operated not as a traditional brokerage, but as a machine engineered to extract money from clients while enriching its employees through deception, pressure, and market manipulation. The core of the operation was a strategy known as pump and dump. Stratton brokers aggressively pushed cheap, low-quality stocks, often belonging to companies with little more than a glossy brochure and a rented office, onto unsuspecting investors. These stocks were carefully chosen because they were easy to manipulate. Small movements in trading volume could create dramatic price swings. Stratton's brokers would call clients relentlessly, using high-pressure scripts, emotional tactics, and false claims to convince them that these obscure companies were on the verge of explosive growth. The moment clients bought in, the price rose, not because the company was valuable, but because Stratton controlled the flow of investment. Once the stock reached a targeted peak, Belfort and his inner circle sold their positions, making massive profits. Immediately after, the price collapsed, leaving clients with worthless shares. Stratton Oakmont operated in an atmosphere that blended aggression with indulgence. Brokers were rewarded not for ethical behavior or long-term performance, but for their ability to generate constant cash flow. The culture encouraged reckless spending, drug use, and a sense of invincibility. Employees competed fiercely for status, bonuses, and recognition, fueling an environment where manipulation became normalized. Belfort designed the firm to be a place where morality was irrelevant as long as money kept flowing. Behind the scenes, Belfort used offshore accounts, shell companies, and cash smuggling techniques to hide profits and evade regulatory detection. Stratton Oakmont grew so rapidly that regulators struggled to keep up, and by the time investigations began, the firm had already extracted hundreds of millions from investors. Belfort's charisma and persuasive abilities played a major role in delaying scrutiny. He projected confidence and success, allowing him to operate for years despite numerous red flags. When Stratton Oakmont finally collapsed, the damage was devastating. Thousands of investors, many of whom were ordinary workers, retirees, and small business owners, lost their savings. Some were persuaded to borrow money or liquidate retirement accounts based on Stratton's promises. The emotional and financial cost was profound, yet largely overshadowed by the sensationalized portrayal of Belfort's lifestyle in popular media. The legal consequences were significant, though not proportionate to the scale of the fraud. Belfort served a relatively short prison sentence after cooperating with authorities and agreeing to pay restitution. Despite owing hundreds of millions to victims, he later reinvented himself as a motivational speaker and author, capitalizing on the notoriety of his crimes, an outcome that sparked public debate about accountability and moral responsibility in the financial world. What makes Belfort's story especially instructive is not just the fraud itself, but the cultural environment that allowed it to thrive. Stratton Oakmont exploited human emotions, greed, fear of missing out, trust in authority, and the desire for rapid success. The scheme succeeded because it tapped into a universal vulnerability, the fantasy of getting rich quickly. Belfort did not invent financial manipulation, but he refined it into a system, wrapped it in charisma, and turned it into a spectacle. The legacy of the Wolf of Wall Street is not his lavish lifestyle, but the reminder that financial markets are only as ethical as the people who participate in them, and that even the most theatrical frauds can cause real, lasting harm. The rise of cryptocurrency and blockchain technology created a new frontier for innovation, but also for financial deception on a global scale. While traditional fraud schemes required physical infrastructure, banks, or brokerage firms, digital platforms introduced an entirely new environment where hype, anonymity, and technical complexity made it easier than ever to mislead millions of people at once. The crypto era produced some of the most audacious frauds in history, blending modern technology with centuries-old manipulation techniques. One of the earliest and most scandalous examples was OneCoin, founded by Ruja Ignatova, a woman who branded herself as the crypto queen. OneCoin was marketed as a revolutionary digital currency poised to compete with Bitcoin. Ignatova held massive stadium-style events, showcasing the currency as a guaranteed path to wealth. Investors from over 175 countries joined, believing they were early adopters of the next global cryptocurrency. But OneCoin had one critical flaw: there was no blockchain. The coin didn't exist in any real decentralized form. The entire system was controlled by OneCoin's servers, which fabricated transaction histories and coin values. Instead of mining coins, investors bought packages that funded the company directly. The prices displayed in accounts were arbitrary numbers designed to maintain enthusiasm. By the time the scheme collapsed, more than $4 billion had vanished. Ignatova disappeared in 2017 and remains one of the most wanted fugitives in the world. Not long after, the world witnessed BitConnect, another infamous crypto fraud. Unlike OneCoin's polished marketing, BitConnect relied on grassroots hype, aggressive online promotion, and a cult-like community presence. BitConnect advertised an algorithmic trading bot that supposedly generated extraordinarily high and consistent returns. Investors were encouraged to lend their crypto assets to the platform in exchange for daily profits that bordered on the impossible. The BitConnect token skyrocketed in value, driven by speculation and relentless enthusiasm. Thousands of online influencers promoted the platform, fueling the illusion that BitConnect's success was unstoppable. But like all Ponzi schemes, the structure required constant inflows of new money. When regulators issued warnings and the hype began to fade, the system collapsed almost instantly. The token lost more than 95% of its value in a single day, wiping out fortunes and leaving investors with near-worthless digital assets. If OneCoin and BitConnect represented early crypto-era frauds characterized by secrecy and exaggerated claims, the collapse of FTX in 2022 marked a new level of sophistication and devastation. FTX was not a fringe operation. It was one of the largest and most respected crypto exchanges in the world. Its founder, Sam Bankman-Fried, cultivated an image of intellectual brilliance, philanthropy, and transparency. FTX secured partnerships with celebrities, sports arenas, and political leaders. Major investors, from venture capital funds to global institutions, poured billions into the company. Behind the scenes, however, FTX was deeply entangled with Bankman-Fried's trading firm, Alameda Research. Customer funds deposited on the FTX exchange were secretly transferred to Alameda to cover trading losses and speculative investments. Billions of dollars that users believed were safely stored on the platform were being used without their knowledge or consent. Internal controls were virtually non-existent. No proper accounting systems, no risk management, and no separation of customer and corporate assets. When a leaked balance sheet exposed the instability of Alameda and the overvaluation of FTX's proprietary token, FTT, confidence evaporated. A mass withdrawal request revealed that FTX did not have the funds to meet customer demands. The exchange collapsed within days, resulting in one of the largest financial disasters in digital asset history. Estimates suggest that over $8 billion in customer funds were lost. These modern crypto frauds share several critical characteristics. They leveraged technological complexity to obscure simple truths. They relied on community-driven hype, exploiting social networks, influencers, and fear of missing out. They thrived in regulatory gray zones, where oversight lagged behind innovation. And most importantly, They capitalized on the universal human desire to believe in revolutionary opportunities. The digital age did not create fraud, it amplified it. Cryptocurrencies provided new tools and new narratives, but the underlying schemes were rooted in familiar psychology: trust, greed, hope, and the allure of being early to a transformative opportunity. The stories of OneCoin, BitConnect, and FTX demonstrate that technology changes quickly, but human vulnerability remains constant. Financial fraud is often associated with rogue traders, corrupt executives, or charismatic entrepreneurs, but some of the most far-reaching deceptions in history were executed not by individuals, but by governments themselves. When a corporation collapses, investors lose money. When a nation deceives its citizens or the world, entire populations suffer. Political financial fraud operates on a scale unmatched by private schemes, blending economic manipulation, propaganda, secrecy, and state power. One of the most notorious examples is Greece's concealed debt crisis prior to the 2008 financial meltdown. For years, the Greek government used accounting tricks and complex financial derivatives to hide the true size of its national deficit. With the help of major global banks, liabilities were reclassified or pushed into the future, creating the illusion of stability required to meet European Union financial criteria. The deception allowed Greece to borrow heavily at low interest rates, but when the truth surfaced, the consequences were catastrophic: austerity measures, mass unemployment, social unrest, and one of the deepest recessions in modern European history. The crisis revealed how government-level financial manipulation can destabilize entire regions. Another example is Argentina's repeated currency and debt crises, fueled by cycles of overspending, manipulated economic statistics, and artificially pegged exchange rates. Successive governments tried to maintain public confidence through controlled inflation reports and fixed currency values that did not reflect reality. When the peg inevitably collapsed in 2001, millions of Argentinians lost savings overnight, banks froze accounts, and violent protests erupted. The political leadership had engineered an illusion of prosperity that crumbled suddenly and brutally. Political deception is not limited to democratic nations struggling with fiscal pressure. In authoritarian regimes, financial manipulation becomes a tool of control. Zimbabwe under Robert Mugabe represents an extreme case, where government policies, corruption, and money printing led to one of the worst hyperinflation events in world history. Prices doubled every few hours, citizens carried bags of cash to buy basic goods, and the national currency became worthless. Hyperinflation was not an accident. It was the predictable result of political decisions that ignored economic reality in favor of power preservation. Similarly, Venezuela illustrates how propaganda and manipulated data can mask financial collapse. The government publicly claimed economic stability while secretly printing money at unprecedented rates, seizing private businesses, and distorting financial statistics. As a result, inflation soared to millions of percent annually, poverty skyrocketed, and the country's infrastructure collapsed. Official reports painted a picture of resilience, but daily life told the truth: empty shelves, mass migration, and a population trapped by the consequences of political deception. Even global superpowers are not immune. The 2008 financial crisis revealed that multiple governments understated risks, ignored warnings, and allowed shadow banking systems to expand unchecked. In some nations, regulators suppressed internal reports that contradicted official narratives of economic health. The desire to project national strength often overrides the obligation to acknowledge vulnerabilities. Political financial fraud often shares several common tactics. Governments manipulate inflation data, understating price increases to calm the public. They hide debt in off-balance sheet entities, delaying repayment obligations. They adjust exchange rates artificially to maintain purchasing power or political favor. Propaganda amplifies success stories while silencing indicators of decline. In extreme cases, dissenting economists are censored, institutions are weakened, and accountability mechanisms are dismantled. Unlike individual fraudsters, who typically seek personal gain, political financial deception serves broader strategic goals: maintaining public confidence, securing re-election, appeasing international creditors, or preserving authoritarian control. but the consequences are vastly more destructive. Entire generations may suffer from reduced wages, collapsed savings, unemployment, and lost opportunities. Recovery from government-engineered financial disasters can take decades. These cases demonstrate that financial deception becomes truly dangerous when fused with political power. A corporation can hide losses, but a government can hide reality itself until the illusion collapses under its own weight. Financial fraud is not sustained by clever accounting alone. It survives and thrives because it taps into universal psychological patterns that influence human behavior across cultures, eras, and economic systems. From Charles Ponzi to Bernie Madoff, from Theranos to crypto collapses and state-engineered illusions, every major financial deception succeeds by exploiting the same psychological vulnerabilities. Understanding these patterns reveals why millions continue to fall for schemes that, in hindsight, seem obvious. One of the most powerful forces at play is the desire for certainty. Humans fear uncertainty more than almost anything else. In volatile markets or unstable economies, people gravitate toward anyone who promises stability, predictability, and guaranteed returns. Whether it is a charismatic entrepreneur or a government official, the promise of safety overrides skepticism. Fraudsters understand this instinct and build their narrative around reassuring, repeatable numbers that appear controlled even when the underlying system is collapsing. Equally influential is greed, though the word oversimplifies the underlying mechanism. In reality, people are driven not by pure greed, but by the fear of missing out, FOMO. When they see others getting rich quickly, when they hear stories of early adopters gaining extraordinary profits, they fear being left behind. This emotional urgency suppresses rational thinking. Many of the biggest schemes grew exponentially because victims trusted the fact that everyone else is investing. Social proof becomes a substitute for due diligence. Another factor is trust in authority and reputation. Bernie Madoff was not questioned because he was a respected figure in finance. Elizabeth Holmes was not challenged because she was surrounded by powerful political and business leaders. Governments often escape scrutiny because citizens assume official institutions cannot lie on such a scale. The human brain takes shortcuts. If someone appears successful, credible, or influential, people assume their claims are legitimate. Fraudsters intentionally build an image strong enough to replace critical analysis. The psychology of fraud also relies heavily on complexity as a weapon. When victims do not fully understand how a system works, they often conclude that their lack of expertise is the problem, not the scheme itself. This creates an illusion of exclusivity, where investors believe they are accessing something sophisticated and advanced. Theranos hid behind scientific jargon, crypto scams hid behind blockchain terminology, and governments hid behind economic models. The more complicated the explanation, the easier it is to hide the truth. Emotional manipulation plays a central role as well. Fraudsters create environments where doubt is framed as weakness or disloyalty. Victims are encouraged to ignore criticism, isolate themselves from skeptics, and view negative information as jealousy or misinformation. This tactic transforms the fraud into a form of identity. People don't just invest money, they invest belief, pride, and self-image. Admitting the truth becomes emotionally painful, causing many to remain loyal long after the evidence becomes undeniable. Additionally, herd behavior amplifies fraud on a massive scale. Humans naturally follow the majority. When a scheme appears large and successful, skepticism disappears. The presence of thousands of investors creates a psychological safety net that masks the underlying danger. Fraudsters use this dynamic to build momentum. Each new investor serves as evidence to attract others. Fraud also thrives because of incremental commitment. People invest a little, see a small return, and then feel comfortable investing more. This technique builds confidence slowly, allowing fraudsters to condition their victims through repeated cycles of reward. Once someone has invested heavily, the emotional cost of admitting failure becomes too high, trapping them inside the scheme even as warning signs mount. Finally, political and economic fraud leverages collective denial. When a government paints a picture of national stability or growth, citizens often prefer the comforting narrative over the harsh truth. Admitting the reality of corruption, debt, or collapse requires confronting uncertainty and fear. Leaders exploit this psychological resistance by projecting confidence, suppressing data, and promising prosperity. The fundamental truth is that financial fraud is not driven solely by clever criminals. It is driven by human nature itself, our hopes, fears, aspirations, and biases. Fraudsters do not create these vulnerabilities. They simply understand them better than their victims. People fall for financial fraud because they want to believe in a better future, easier wealth, or a stable environment. These desires are universal, and as long as they exist, fraud will continue to find new ways to disguise itself.